Hello, my name's Glenn Horn and I'm a volunteer with the CPA Canada Financial Literacy Program. I have been lucky enough to work with entrepreneurs and owners over the past 15 years, and over that time working with their financial statements, they've shared a lot of questions with me which we can go through today. It's going to take about an hour or so of our time presenting together, and this is meant to be an interactive presentation, so if you have any questions, by all means stop me, let's ask them. Also, we'll have time at the end to ask any questions if you have. Copies of my presentation are on your chairs, as well as a couple other resource pieces, glossary of terms and the implications checklist. And if you have any follow-up questions, I've also left business cards at the back of the room. Feel free to pick those up. So let's get right to it. Some of the common questions that business owners ask are, how are cash and accrual accounting different? Why is my balance sheet so complicated? What is depreciation, amortization? Why are prepaid expenses assets and sitting on my balance sheet? How do I account for intangible assets? What are retained earnings? How are earnings per share determined? And what is non-operating income? So let's get right into it. So what's making financial statements so complex? Well, honestly, it's us accountants. We have a lot of rules, and those rules are complicated. So there are really two types of accounting. You have cash accounting and accrual accounting. So let's first look at cash accounting. Cash accounting occurs when payments are received or items are paid. So let's take a look at a sale. So if you have a sale of an item, you will not record that until cash actually changes hands. Now, on the same token, if you have an expense, you will not record that until you actually pay for that expense, cash accounting. Now, accrual accounting occurs when a transaction takes place. So let's look at those same examples. When a sale occurs, you may give credit to your customers and they don't have to pay for another 30 days. Well, you record that transaction as soon as it occurs. On the flip side, for expenses, when you incur an expense, you may not have to pay for that for 30 days, but you record that expense as it's incurred, even though you don't pay for that for another 30 days. Now, some small businesses, whether they be consulting or professional firms, may use cash accounting. However, when you get more complicated and get into a manufacturing type area, typically you'll see accrual accounting. So at this point, you can poll the audience and ask which ones, or by a show of hands, how many use accrual accounting versus cash accounting, and maybe talk a little bit about why they're using one versus the other. So moving on to the basic balance sheet. If you look up at the screen, you can see a basic balance sheet. Now this is advanced financial statement, so we'll get more complicated, but we'll start with the building blocks. So if you look at the left side, you'll see assets, and total assets come down to $100,000. Looking to the right side, you have your liabilities, with liabilities coming down to $60,000. And it's really what you owe. And the difference between the two is owner's equity. So the 100 minus the 60 comes out with your $40,000. So if you think about it, your assets are what you own, liabilities what you owe, and your residual is your owner's equity. So now let's move on. So making the financial statements more complex. Think about your own financial statements and some of the items that may be making them more complex. Let's take a look at assets. If you are a manufacturer, you may have raw materials or work in process. Also, you may see prepaid expenses or depreciation or goodwill and intangible assets on your financials. As well, in liabilities, you may have accrued expenses, payroll, taxes payable, or loans payable. And finally, in your owner's equity section, there's retained earnings, which can be, again, very complex. At this point, you may want to ask the audience what type of assets they have on their balance sheets and their financial statements, and talk a little bit about some of their more complex items. Now let's take a look at a complex balance sheet. In comparison to the last balance sheet we saw, you can see that this one has become much more complex with the addition of raw materials, work in process, some finished inventory. You can also see that we've added goodwill, accrued expenses, payroll taxes, and look at some of those bank loans. Now, let's take a look at some of these items individually. Inventory. So there are different types of inventory, especially if you're a manufacturing company. First, you have, if you're a simple business, you may only have finished goods if you're a retailer or a distributor. Now, if you're a manufacturer, you can have different types of materials. First, raw material, which may just be the cost of the actual material you have. You have work in process, which would be the cost of the material plus any labor that you may have working on that material. And then finished goods, where you have finished the goods, so it includes the raw materials, work in process, and those finished goods are complete but not yet sold to the client. So you're sitting on that finished inventory. While some of these pieces may not be significant to a simple business, when you become more complicated, like a heavy manufacturer, these may become very significant over a long period of time, and you would need to include each of these items as they are significant. I have a client that works in aerospace. They build parts, landing gear for planes. So basically, their raw material is the metal that comes in. Their work in process is the work on that as they're machining those pieces down, assembling them together and testing them. And then the finished good is that finished landing gear, that finished part. At this point, you may want to talk to the audience and ask them what type of inventory they have, what type of raw material, work in process, and finished goods, and just get a conversation going as to what they're seeing on their balance sheets. Another item is prepaid expenses on your balance sheet, and this is where a business prepays for certain assets and it needs to be reflected on the balance sheet. Prepaid expenses may be confusing because when you think of expenses, you tend to think of your profit and loss statement, not your balance sheet. These have also can be called prepaid assets. So let's take a look at an example. Let's look at insurance. So on July 1st, you may have entered into an insurance contract for a year's worth of insurance. Your year end may be December 31st, at which point you've used 6 months of that insurance. But with your year end being at December 31st, you still have 6 months of benefit left to use. So at December 31st, you need to have prepaid expenses. So for instance, if that was $4,000 of insurance, you've used $2,000, you would have $2,000 left as prepaid insurance on your balance sheet. Another item you may have is rent expense. So typically for rent, you pay in advance the month before. So when it comes to the month end, you have prepaid for the next month's rent, so you have to record that benefit on your balance sheet. Now, these are typically items that get used within a year or so it's a short period of time, so you'll also notice they're up in the current assets. Intangible assets. Now, this is an item that is very, very complex. I work with many companies that have accountants on staff and still find this very, very confusing. So if you find this confusing, you're not alone. This can be complicated, one, from an accounting perspective, and two, from a valuation perspective. They can be very difficult to value and they're very soft items. Some of the items that you may think of for intangibles could be trademarks, brand names, patents, copyrights. Think about Apple, Google, even Coca-Cola. Treatment of these on the balance sheet is different whether you create the intangible or whether you buy the intangible. So let's look first at whether you create an intangible. So if you were to create a patentable product and it costs you $50,000 to create a product worth $1 million, you're only going to put those creation costs on your balance sheet. So it'll only be the $50,000. Now let's look at the other situation where you actually purchase that product or that patentable item. You spend $1 million. So now you're going to have $1 million on your balance sheet. Two different scenarios. One, you've created it and only put the creation costs, $50,000, versus where you've purchased it and actually have the full $1 million. You can see where some of that confusion lies. So a special type of intangible asset is goodwill. From an accounting perspective, goodwill is an entry to record the excess over the tangible assets. So let's look at it as an example. If I paid $1 million for a business, I may receive cash, inventory, accounts receivable, prepaids, plant and equipment. I value all of those, less any liabilities I may have, and may come to a value, a fair value of those of say $900,000. But I paid $1 million. So I now have an extra $100,000 that's recorded on my balance sheet as goodwill. So that's what goodwill is. If you think about if you were to buy a large corporation, say Tim Hortons or something, you would pay well in excess of what those assets are just to get that name and some of that brand recognition. These intangibles have unique treatment on the balance sheet, and again, that really adds to the complexity of these. So let's look at another item, depreciation. So on the financial statements, accounting needs to record items at their original cost. So for equipment, you record it at original cost, and then you need to recognize the wear and tear over time, which is depreciation. So depreciation is when you are depreciating a fixed asset, so property, plant, and equipment, where amortization relates to intangible assets, and so it's the reduction of those particular items. So think about it, fixed assets is depreciation, intangible assets are amortized. So let's take a look at the next slide to look at an example. So if we were to buy a dump truck for $50,000, and that has a useful life of 5 years, we would depreciate that value or the use of that over the 5 years. So if you think about this, in year one, you have $50,000 on your balance sheet. You've used 1/5 of that value, so now you have your fixed assets of $40,000. The next year, it keeps going down, 30,000, 20, 10, and by 5 years, you used all the value of that dump truck, so it's now on your balance sheet at $0. Depreciation should match the useful life of the asset itself. So if you have a dump truck, it may be 5 years, but if you have a building, it may be 20 or 40 years. So now let's jump to the other side of the balance sheet, looking at accrued liabilities. So accrued liabilities are expenses that are incurred but not yet paid for. May include accrued expenses like sales tax due, wages to employees, and payroll taxes. A good example is wages to employees. If you were to pay them on the 1st and 15th of the month, think about on the 16th of the month, you now owe them 1 day's pay. On the 17th, 2 days' pay. So when you get to the end of the month, you now owe them, say, 15 days worth of pay, but because you pay on the 1st and the 15th, it's not actually payable until the 1st of the next month. So if your year end is on the 30th, it is an accrued liability. Another item is sales tax. You may have sales tax that you collect on your revenue that you have to pay at a later time when you have your remittances. Again, you've collected those, you will owe them, but you don't owe them yet. They're not payable, so that's why they are an accrual. A certain type of accrued liability is unearned revenue, and it's also known as deferred revenue. Deferred revenue is where you're paid in advance for a service you may be providing. Think if you're a snow shoveling business, and on November 1st, you're paid for the entire year. Now at December 31st, you've earned some of that revenue because you've been shoveling some of the snow. However, you still have the rest of the winter to do that, so you have not earned that revenue. So that unearned revenue will sit on your balance sheet. So let's take a look at bank loans payable. Bank loans payable can be confusing for a couple different reasons. First of all, they show up on 2 different areas on your balance sheet. First, you have it in your current liabilities, and second, in your long-term liabilities. So your current liabilities, the reason why they sit there is that's the amount of principal due within the next year, and the long term is what's due after that. So if I have a $30,000 loan, but I owe principal payments of $5,000, that $5,000 shows up in my current liabilities. And the remainder, the $25,000, shows up as long term. The other thing you'll maybe notice that I said principal payments, not total payments. So the only items that show up on your balance sheet are your principal payments. They do not include your interest payments. Those show up on your income statement as they're accrued. So 2 items that can be confusing. So now let's take a look at owner's equity and retained earnings. So here we're going to actually take 2 slides because this is a fairly complex section. So it's an often confusing term, retained earnings, and what it really is, it's an accountant's really way of saying cumulative earnings or profits since the inception of business. So retained earnings, and a question that I commonly get is, I have retained earnings, is that cash? Well, retained earnings isn't cash, and it's often a common misconception. A couple of reasons why is because if you look at it, we have accrual accounting, which we've been talking about, and so you may have some items on your income statement that may be not cash items, so there's a difference between cash and your retained earnings, and these could really bear little relation to each other. Now, there are a couple different things that you can do when you have your profits. First, you can pay it out as a dividend, or 2, you can retain it in the business and reinvest it. And what retained earnings is those amounts that have been earned, retained in the business, and are reinvested back in the business. You'll also maybe see these in other financial statements talked about or named accumulated surplus, accumulated profits, or undistributed profits. So now let's take a look at an example of the calculation of retained earnings. So if we look at the prior balance sheet, you can see there's retained earnings of $10,000. Now you have net profits for the year of $5,000. So if we look to the next year, you can see that the current balance sheet has retained earnings of $15,000. The reason for this is there's also been no dividends paid, so that amount is the 10 plus the 5 equals the $15,000. Now let's look at what's making the profit and loss statement more complex. So there could be some non-cash items, and we're going to go through those. So first, let's look at what's the difference between net profit and cash flows. Well, if we look at accrual accounting, there's some differences that we've seen with these, and we can see some items. For example, if you were to have your office cleaned, you have a December year end. Over the Christmas break, you were to have your office cleaned, and then come the new year, you were to pay for that item. That expense would show up in your prior year. However, you don't pay for that until the difference. So it's the difference between your expense and the cash item. Also, you may have some non-cash expenses. As we were talking about when you buy a capital asset, you have the wear and tear of these assets, which are depreciation, or the use of intangibles, which is amortization, showing up on your profit and loss statement. And those are non-cash items. So there's not really a correlation between your profit and loss and your actual cash itself. So looking at depreciation, as I was mentioning, it's really the accountant's way of using or recognizing that wear and tear over the life of assets. And so the $10,000 you see on the screen is the use of that asset over time. Operating profit can be a real key metric for owners of businesses or some investors. Now, some other investors may look at other items like profit and loss before your non-cash items as they deduct that, because they're really looking at your cash flow for the business itself. Some other items that make the profit and loss statement more complex are non-operating activities. So your operating profit really is your normal business activities, your normal day-to-day. If that was selling widgets, it would be looking at that particular piece. Looking at your non-operating activities, you may have items like interest, you may have income taxes, or any special activities in your business. Interest expense is included as non-operating activity because it is related to your capital structure. So let's look at that dump truck back that we looked at a few slides ago. If you were to purchase that with cash, you'd have no interest. Where if you were to get a loan for that, you would have interest. That's not part of making widgets, so that's included as a non-operating activity. Taxes are included in non-operating activities as well, because you may have different taxes from country to country, or even from province to province. Other special activities, there may be, so other revenue and gains. Again, that dump truck you may have sold at, say it was 3 years old, and you made a gain on it. Well, that's not your regular business activity, so those are showing up in other revenue and gains. Or you may have inventory. You may have come out with a new product line, making the older product line obsolete or needs to be written down. So that write-down is a little unusual and not recorded in your operating, but in your non-operating activities. Now let's change pace a little bit and examine earnings per share. First, you need to understand the equity and how equity is determined. So let's say that we are investing in a business and we're looking at capital stock. So I have a $50,000 investment and I'm going to have that at $10 per share. So what I get is 50,000 shares. Now, in a private company, that's usually an agreed upon price between the two parties investing. It may be my initial investment or somebody coming into the business. Where in the public company, you're usually looking at that in a public realm, and that's a negotiated price. Now, understanding earnings per share, now that we understand the capital structure, we can look at the earnings per share itself. So that really measures the profitability that you have over time. So let's look at the calculation specifically. You have net profit for the year less or divided by your earnings per share. So let's go back to our example where we had 5,000 shares. If we earn $32,000 over the year, we divide that by $5,000, you can see that our earnings per share for the year is $6.40. Earnings per share may be different from company to company. So you may have this as a good comparison within the company, but be careful to compare this to other companies. So if I was to compare another company, this company I have $50,000 for 5,000 shares. I have another company where I have $50,000 and 50,000 shares. My earnings per share on that example would be 64 cents as opposed to $6.40. So even though it's the same, you can see that it comes with a different result. So it's hard to compare company to company. So now I'd like to turn you to some of the resources that we have provided you. You can see we have a glossary of terms. So this can act as a one-page cheat sheet for you that just has all the terms and their definitions on them. There's also an implementation checklist that you can use as you're going through your financial statements and things you may want to consider or look at. At this point, I would open up to the floor for any questions that they may have. You're going to have some particular questions you may want to cover. If you're not able to get some of the questions answered, you can tell them that you can follow up with them after the presentation, or you've left your card and they can follow up with you if they have questions after that. Thank you very much for your time. It was a pleasure sharing some of my experiences that I've had with advanced financial statements. Have a great day.